Hello traders, I'm Luke from Disciplined Trader. This video is part of the Trading Basics series, and in this one we are going to look at leveraged trading. We will discuss what leveraged trading is, how it works, and the two different types of leveraged trading accounts you can open. The first thing I want to do is demonstrate how an unleveraged trade may work. Let's say for example you have an account of £1,000 and want to buy shares in ABC Limited. The current share price is £100, so using your £1,000 you can buy 10 shares, which you decide to do. 2 weeks later, the share price now sits at £102. You sell your 10 shares and realise a profit of £20. From your £1,000 investment, you have made a return of £20, which equates to a 2% return on investment. If you were to make the same trade with a leveraged account, your return on investment would be increased. Let me demonstrate why. As before, you have £1,000 in your account and want to buy shares in ABC Limited. The share price as before is £100. However, this time your broker is enabling you to leverage your account. This essentially gives you more buying power with the money you have, as your broker only requires a deposit to open a position. That deposit will only be a fraction of the actual trade cost. This deposit is called the margin. The margin requirement will vary from broker to broker and market to market. Let's say in our example, the margin requirement is 20%. It is much smaller on a lot of markets in reality. This would mean our broker would only require a deposit of £200 for the same 10 shares. 2 weeks later, the share price has risen to £102 as it did in the previous example, and you sell your shares. Now you have made £20 from £200 invested, which is equivalent to a 10% return on investment. Now you may be thinking, okay, but I still only made £20. And that's true, but the difference is you still had £800 of your £1,000 available. You could have invested £500 of your account in the leverage trade. This would have bought 25 shares at £100, which you would have then sold at £102 2 weeks later for a return of £50. That is still a 10% return on investment, but £30 more than you made on the unleveraged trade by only using half of your account. Hopefully that has demonstrated how powerful trading with leverage can be. Obviously, there are risks that come with trading with leverage. In the same way leverage can amplify your profits, it can just as easily amplify your losses. Hence why, as we have already covered in this series, having a solid risk management strategy is so important. Before we move on to the trading accounts that use leverage, I just want to cover leverage and margin in a bit more detail so you fully understand it. Leverage trading, also known as trading on margin, is borrowing power afforded to you by your broker. This can be anything from 2 to 1 to 500 to 1, although there are limits on this depending on what country you are in. Here in the UK, for example, this is capped to 30 to 1 for retail traders. In the example we just looked at, we used 5 to 1 leverage. Margin is the amount of money you need to open a leverage trade. This will be a percentage of the total trade cost. In the example we just looked at, the margin was 20%. We could have worked this out from the leverage by dividing the total trade cost by the factor of leverage we were using. The total trade cost was £1,000 and the leverage factor was 5. This gives us £200. £200 as a percentage of £1,000 is 20%. When you open a trade, the margin amount isn't removed from your account, more kept to one side. You often see this described as blocked funds or something similar whilst the trade is open. Maintenance margin is the amount of money you need to cover any current losses on the position, if there is any. This will usually be the other funds you have in your account. If the losses on an open position start to get to the point where they could exceed the margin and maintenance margin, your broker will issue you with a margin call, which essentially means you either need to top up the account with more funds to cover the open position, or close the position and realise the loss. They do this as leverage trading does enable you to lose more money on a trade than you have in your account. Going back to our previous ABC Limited examples, if on the unleveraged trade the price instead fell to £40 from £100 and you sold at £40, you would receive £400 from the sale of your 10 shares and would have lost £600. This is fine from the broker's point of view as they don't have any shared exposure in that trade. All the money was put up by yourself. In the leveraged example, You bought 25 shares in ABC Limited with 5-to-1 leverage from the broker. The margin for this trade is £500, so this is kept to one side by the broker, leaving £500 spare in your account. If the price then fell to £40, as in the previous example, your trade would have lost £1,500, so your broker would have issued you with a margin call long before the price reached this level, informing you that you needed to add more money to your account, otherwise the trade would be closed for you. So how can you utilise leverage? Well, there are two main account types that you can open, either a spread betting account or a CFD account. These account types trade derivative markets. A derivative market is a market that follows the price movement of an underlying instrument or asset. You can trade these markets without ever owning the instrument or asset, and it's for this reason we are able to utilise leverage on these accounts. An example of this with the broker I use would be the UK 100. This market is a derivative of the FTSE 100. It follows the price movement of the FTSE 100, but when I trade this market, I never actually own any of the underlying asset. Both account types use leverage, but have small differences, so let's look at each in detail. It's worth mentioning here that I'm not a financial advisor, and this should not be considered financial advice. You should do your own research before opening and trading an account. Spread betting is a leveraged account type that is classified as gambling here in the UK. You may want to check the classification if you are based elsewhere. For example, in the US, a spread betting account would be illegal. This means that any profits made via this account are tax-free, as the UK does not tax any profits made from gambling. You enter positions on this account type by essentially making a bet as to whether the market you are trading is going to go up or down. Your bet is a specified amount of money per point or pip. For example, let's say you thought the pound-dollar currency pair was going to rise, you could enter a long position at £10 per pip. This means that for every pip that currency pair moves up, you make £10. Equally, for every pip the pair moves down, you lose £10. A CFD, or contract for difference, account works in a very similar way, but is not classified as gambling. Therefore, any profits made on this account type are taxable. However, losses can be offset against profits for tax purposes. Essentially, with this account type, you are agreeing to exchange the difference in price on a market from the point the contract is started to the point it is closed. Because trading a single entity on markets isn't really viable, as you would barely make any money, positions are quoted in standard lot sizes, which vary in size from market to market. Currency markets, for example, a standard lot would be 100,000 units, whereas a standard lot would be equivalent to 100 shares on the stock market. Often these lot sizes are then broken down into micro, mini and standard sizes. Again, looking at the Forex market, a micro lot would be equivalent to 1,000 units of the currency. Mini would be 10,000 and a standard lot would be 100,000. Because trades are structured in this way, calculating your position size can be slightly more difficult. However, there are position size calculators available on the internet for free, such as this one on the Baby Pips website. I'll put a link to this one in the description below. Simply enter the details of your trade into the calculator and it will tell you what lot size you need to trade. And that wraps up this video on leverage trading. I hope you have found it useful. If you have enjoyed the video, please feel free to leave a like on it. If you have any questions or want me to cover any other topics in future videos, please let me know in the comments down below. Also, subscribe to the channel for more videos like this one. I will be continuing this Trading Basics series to provide new traders with all the knowledge they need to get started. Thank you very much for watching and I hope you all have a good trading week.